Hi everyone, welcome back to my channel. So today's video is all about how to think 2 steps ahead in the market. Now with thinking ahead, I'll go into detail about mapping market responses beforehand and really just evaluating price levels along with predefining how you'll act in certain scenarios while using, of course, market structure clues. And this can be anything from like liquidity, order flow, IV, volume, all that good stuff. And this will help you base your decisions. And this allows you to enter trades with validity instead of reactively chasing price. So I'll provide a full breakdown of these elements. Okay, so jumping straight into it, y'all can see I have QQQ pulled up here on the chart. And the first thing that I want to discuss, of course, is going to be market structure. So let me go ahead and zoom in. Now, y'all have heard me mention before that knowing the phases of the market is super important to your trading. So I won't necessarily go into detail about accumulation, the rally, distribution, and the sell-off phases because I have a video and I'll link that down below. But I do want to provide some details on how you can utilize multiple time frames, and this can help you with your entries and exits. Because ideally, you want to look for a breakout in the markup that has more follow-through than the same breakout during the distribution phase. And what I mean by that is, it's always best to find a low or a high within the market. And when you spot these supply or demand zones, you want to take full advantage. Now, of course, it's easier said than done, especially if you're a beginner. But the market will always reveal to you what you need to know. So taking a look at this example here, we can see that this demand zone took place around 10 a.m. Now, this large-bodied bearish candle is not significant on its own. Clearly, we can see the start of the rejection took place around 8:46 a.m. And it was a pretty clean sell-off to the downside. Buyers, of course, tried to take back over control, and they held a brief moment of bullish momentum. However, it was short-lived because we can see the rejection continue to take place. And in this area, there was also a level of consolidation in the market. So anytime I'm identifying these types of demand zones, I'm always looking to pinpoint as close as I can to the actual low. So with any trade that you're analyzing, of course, you always want to use top-down analysis. And for those who may not be aware of what that means, essentially all you need to do is make sure that you start on larger time frames. So that could be the monthly, the weekly, the daily, whatever you so choose, and then you narrow it down to lower time frames. Because every time frame for the most part will give you a different vantage point. So always be sure to analyze using various perspectives. Now, going back to it, anytime you're taking a look at any supply or demand zone, you want to make sure you're paying close attention to liquidity and order flow. Because price reacts where liquidity lives. And especially if you're trading options, big OI strikes, POCs, and VWAP will always help you. So you can always anticipate measured levels and prepare your execution around them. So for instance, in real time, if you were watching the market play out at 10 a.m., you would see that here in Thinkorswim, this would have been marked as the low. Now, of course, it may change as the price level moves up or down. But in this case, it reached the ultimate low for the day. Now, of course, in real time, this doesn't 100% signal that you should take a play for calls. It's definitely a big clue, but it doesn't stand singular as a reason to enter a trade. Because this candle here at 10:02 a.m. does present a level of indecision. We can see that the upper wick and the lower wick are just about as equivalent as the body of the candle. Not 100%, but it's close enough. So y'all have heard me say time and time again, when there's indecision in the candle, that means just wait for confirmation. Now, volume can be one element that can help you confirm. Because volume, in my opinion, is a determinant. And we can see here that there was a slight spike in volume at this 10:02 mark, just slightly elevated from that 10 o'clock mark. Now, a move without expanding volume is suspect in my opinion, and that's simply because a move that prints with unusual high volume on the breakout or even the breakdown is validated. And in this case, it did provide at least one clue. Now, the next candle closed at the very top of the wick of the candle that preceded it, which again, in this case, doesn't mean 100% that it'll be a rally. Now, this third candle within the breakout obviously has some strong buying conviction, just based strictly on the body of the candle. So clearly, if we were to take a look, the options positioning and even the implied volatility would play a major role in this move. And basically what that means is that anytime you combine your bias with, let's say, IV rank and skew, it can tell you when the premiums are rich or cheap. And that's necessary for structuring your trades. And you can also use momentum to confirm this as well. And y'all know how I feel about the ADX and the ATR for understanding any type of advancement or decline in the market. It's basically like a sector function that you can use as an indicator, and it helps you judge if a move is isolated or if it's market-wide, because market-wide moves have better odds for continuation, even when we see slight pullbacks like here at 10:14 a.m., because you can better plan for projected reactions, and possibly two-way volatility if there is mixed feelings that are displayed on the chart. So some strategies that actually work when you think 2 steps ahead are one, going to be bias plus confirmation. Then you can also set up a conditional entry. So let's say you're looking to define your bias on a higher time frame, for example. Let's just say we're looking at the 15-minute. I'm going to go ahead and zoom it in. You can specifically look at the market key levels, and of course, again, combining this with like the VWAP if you want to trade that. And then also make sure you always take a look at the prior high and the prior low for the day, and certainly look for the major option strike prices that correlate to this. And if desired, you can place your conditional orders only if the stock or ETF prints your trigger at the mark greater than the level. So if you're very particular, you can make sure that you also attach an OCO bracket with a stop and target, of course. And you can enter only when the market proves your analysis to avoid being wrong with unlimited consequence. This also helps you define liquidity sweep anticipation as well, because if a price approaches a high OI strike, that acts like a magnet in the market, and you can anticipate a short squeeze or a pin. So after you've done evaluating, let's say on the 15, you can do a drop down and go to, let's say, the 5-minute. Now from here, you can go ahead and predefine an order to fade the sweep, have a tight entry and tight stop, of course, or you can, of course, ride the wave, letting momentum enter after a breakout. But the clue is to watch time and sales for aggressive prints at the ask or large block prints. And I've showed y'all how to do that before. You just simply click on the trade tab, and then you're going to scroll all the way down to where you see it says option time and sales. And this will tell you all the valuable information that you'll need as far as how the market is moving. So it's basically like a behind the scenes look at what's really going on. Now, adding to this, you want to make sure that the IV rank is going to always make sense, because you always prefer a defined risk, especially if you're looking to buy cheaper spreads with protection. So if the IV rank is low, you may buy premiums directionally for calls or puts, or you could do straddles if you expect a move. Now, when planning to stay steps ahead, place your entries before the IV breaks after release in order to make sure you're capturing the majority of the profit on the move. So it's basically like a pre-sized risk that can play in your favor. Now, of course, you may not be one to enter on the first break, and this would make sense if you're more conservative. However, aggressive demand at a breakout, like a partial size, is totally fine as well. You can always order in with the rest of the size on a high-level retest of the breakout. And this just allows you to average into a confirmed trend while keeping your initial risk limited. So just to recap, make sure the rising OI is on the same side as volume, because this suggests that new money has entered and it's not just position rolling. And analyzing the charts will always tell you the sense of urgency, because momentum above a ask in quick succession may mean buyers are aggressive. Even when you look at skew changes, sudden put buying or call buying in chain precedes directional moves or hedging flows, so keep that in mind as well. And if you need a little more direction on this, of course, y'all know I fully mentor traders, so I'll leave a link for that as well. But if you're brand new and you feel like you do need additional confirmation, always look at the ATR expansion. This, in combination with, let's say, a flag pattern, will allow you to see that volatility breaking out of a low ATR base signals that the trend is an opportunity for a continuation. Now, of course, it won't last forever, but by the time it does slow up, with good risk management, you'll already be out of the trade. Now, to get further deep into a trade structure, remember your pre-market planning. I always recommend choosing tickers that are liquid, because you can easily mark the bias, any types of key levels, and you can better analyze supply and demand. So if it breaks above a certain level, you can enter at 50% on the breakout, or you can rest on the retest, but always make sure that your targets make sense for your R&R. Because a rejection at a certain level with high volume, it can show you that the market may go short. Not always, but it is a possibility that it could happen. And if the move fails intraday and breaches your stop, definitely don't re-enter unless new evidence appears, whether that's a fresh volume spike or a different type of catalyst, because you always want to expect sellers to step in, especially when the move is extended to the upside. So if you're looking to sell, you don't want to sell in a consolidation zone. You always want to look for puts where you can sell into the strength. But keep in mind that you're ready for any type of like dealer hedging, because this will separate a rejection from genuine momentum based upon the rules that you've already preset. So when you are choosing a contract, expect the price to gravitate toward a strike that the market is already dictating. And if you're one to also use mean reversion scalps around strikes or trade option spreads, anticipating the pinning behavior will always be to your benefit as well. Because all this does is help you increase profitability. But you want to make sure that your logic is concrete, because this allows for just those better entries and fewer false starts. And it really just helps you avoid slippage, because more winners are captured when you position the catch to follow through rather than late entries. So it's basically setting it up for fewer losses due to missed timing, because the structure is completely contingent upon how you plan for the rally or for the drawdown. And that's the main way to improve and compound your returns every single day, y'all. Because it forces you to be disciplined because you have those rules set before each and every trade. And y'all know I'm big on telling y'all remove the emotion, because that's what comes with it. So when the scenario maps out the way you need it to, just make sure that your clues are reliable and it precedes the moves to eliminate most of the noise. So in my opinion, what matters most, of course, is going to always be liquidity. So trade only names that actually move in the market, y'all. And at all times, confirmation beats hype every single day of the week, so never ignore the tape. And if we're to add to it, just make sure the IV context is in play too. So options trades must respect the premium pricing and the skew. Account for all of that. And then more true than anything is always know the dollar risk before you click send on any trade. Because what that gives you is a rule for if this happens, then you already know the consequence for either success or failure, however it plays out. So in sum, if I had to provide a checklist for y'all to ensure that you're 2 steps ahead, first thing I would do is say make sure that you analyze open interest and volume. Mark your bias up on the chart, and you can again use that top-down analysis. Look for the IV rank. Decide if you're going to trade on a breakout or if you're just looking to ride the wave. And then just make sure you always refine the threshold. Definitely make sure you use the on-demand feature to do some back tests, because that'll always help you understand how timing and feels can match your analysis. Because y'all already know that the market is going to reward preparation far more often than it will luck. So definitely take your time with understanding these concepts. Okay, so y'all, that's everything I wanted to cover. And with that, that'll pretty much do it for this video. Y'all already know if you found any of this information to be helpful, feel free to leave me a comment down below. As always, I thank y'all so much for watching. And of course, I'll see y'all in my next one.